Welcome to Talk Tickers. Today we are not looking at a quarterly earnings beat or a new product launch. We are looking at the mechanics of a catastrophe. We are looking at how the smart money, perhaps the smartest money that ever existed, almost broke the world.
It's the definitive case study. I mean, really, if you want to understand leverage, if you want to understand model risk, and if you really want to understand the terrifying illusion of liquidity, you have to understand long-term capital management.
LTCM. Even just saying the acronym sends a shiver down the spine of anyone who was trading in 1998. It's become a bit of a ghost story on Wall Street, hasn't it?
It really has. Because this wasn't just a hedge fund blowing up. We see that, all the time. It's part of the ecosystem.
Right, it happens.
This was different. This was a single private investment partnership staffed by 2 Nobel Prize winners and the most legendary bond traders on Wall Street that managed to bring the global financial system to the absolute brink of a frozen collapse.
And the numbers are just staggering. In a matter of weeks, they lost $4.4 billion. But looking at all the research we have now, the scariest part isn't the loss itself. It's the contradiction at the heart of it. This fund was designed to be market neutral.
That's the key phrase, market neutral. That was the whole pitch.
Right. It was supposed to be immune to the direction of the market. It didn't matter if the S&P went up or down. It didn't matter if the economy was booming or busting. And yet, it failed so spectacularly that the Federal Reserve had to literally lock the CEOs of the biggest banks in a room until they fixed it.
And that is exactly why this matters today. We aren't just doing a history lesson here.
No.
We're looking at the mechanics of smart money failing. Because the risks that took down LTCM, things like hidden leverage, the sudden breakdown of correlations, and the complete evaporation of liquidity, those are the exact same risks present in today's algorithmic and high-frequency trading environments.
So here's the scope for this deep dive. We are going to try to strip away the myths and look directly at the trading book. We're going to cover the specific arbitrage strategies they used, what we call convergence trading.
You have to. You need to understand the nuts and bolts of the machine before we watch it explode.
And we'll also explain the wealth effect amplification mechanism. This is so crucial, and it comes from some really detailed analysis of how liquidity crises actually function. It explains why smart money sometimes destabilizes the market instead of stabilizing it.
Which is completely counterintuitive, right?
Totally. And finally, we will dissect the rescue, that consortium of 14 banks, and the massive moral hazard it created. Our goal is simple. We want to understand how measured risk turns into systemic panic.
Let's get into it.
Let's start with the concept. The core strategy of LTCM was hedge fund arbitrage, specifically something called convergence trading. Now, usually when people hear arbitrage, they think of risk-free profit, like buying gold in London and selling it in New York for $1 more instantly.
Right, pure arbitrage.
But that's not exactly what they were doing, was it?
Not exactly, no. That's pure arbitrage, and those opportunities are, incredibly rare and tiny. What LTCM was doing was statistical arbitrage, or as you said, convergence trading. At its simplest level, convergence trading is a bet on normalization.
Normalization, so just a return to the mean.
Exactly. The premise is that similar assets should have similar prices. If you have 2 assets that are economically nearly identical, say a U.S. Treasury bond and a mortgage-backed security with very similar cash flows, they should trade at a predictable price relationship to one another.
Right. If they're effectively the same thing, if they pay the same interest and have the same maturity, they should cost the same amount, or at least they should move in lockstep.
Precisely. It's the law of one price.
Right.
But markets are noisy, markets are human, sometimes due to a liquidity crunch or a panic or just irrational selling by a big pension fund, the prices diverge.
To get out of whack.
Completely out of whack. The Treasury bond gets expensive because everyone wants safety, and the mortgage bond gets cheap because someone is dumping it. The spread widens.
And that gap, that spread, that's the opportunity.
That is the trade. You buy the cheap one and you sell short the expensive one. You are betting that over time, that relationship will revert to the mean, the prices will converge.
So if I'm understanding the mechanics correctly, you don't actually care if the price of bonds goes up or down, generally.
Yeah, no, you don't. Not at all.
You only care that the difference between your 2 bonds disappears.
Correct. And this is what they called the safety margin. They weren't guessing. This wasn't a gut feeling. They were looking at historical data going back decades. They viewed these divergences as anomalies caused by noise traders.
Noise traders. That's a polite academic way of saying dumb money, isn't it?
In the academic sense, yes, absolutely. LTCM viewed themselves as the adults in the room, the rational actors. They believed that markets are efficient over the long term, even if they are wildly inefficient in the short term. They were just waiting for sanity to return.
So this leads directly to the concept of market neutrality.
Yeah.
This is the part that seduced so many investors. They pitched this as a strategy that wasn't betting on the economy.
That's the key selling point. If you are a traditional investor, you worry about the stock market crashing or interest rates spiking. You worry about a recession.
All the big macro stuff.
Right. LTCM said they didn't care. Because they were long one asset and short a similar asset, they were hedged against the general direction of the market.
Let's unpack that with a specific example, because I think this is where people can get a little lost. Let's say interest rates spike by 2%.
Yeah.
That crushes the value of bonds, right?
Right. If interest rates rise, the bond you own, the cheap one, loses value. That's bad for you. But the bond you are short, the expensive one, it also loses value. And when you are short an asset and its price drops, you make money.
So the loss on your long position is offset by the gain on your short position.
Ideally, yes.
Yeah.
The movements cancel each other out. You don't care about the level of interest rates. You only care about the gap between the two specific rates you're trading. You are betting that specific gap will narrow.
It sounds like the perfect mousetrap. It sounds incredibly safe.
It sounds incredibly safe. It's the illusion of safety. The pitch was essentially, we can generate consistent high returns regardless of whether the economy is booming or in a recession. And for a while, they did. Boy, did they.
But to understand how this went so wrong, we have to look at the people who run the machine. We can't talk about LTCM without talking about the egos involved. This wasn't a group of cowboys. This was the dream team.
It really was. You have to go back to the launch in 1994. The founder was John Meriwether.
The king of Wall Street bond traders.
He was a legend at Salomon Brothers. He was the head of the bond arbitrage desk, which was just a license to print money. He was the guy who essentially professionalized the idea of using math to find profits in bond spreads. Before him, bond trading was a lot of gut feel. He brought in the quants.
But when he started LTCM, he didn't just hire traders. He hired the guys who wrote the textbooks that the traders were reading in college.
Robert Merton and Myron Scholes. These names are, they're titans in finance. They literally invented the Black-Scholes model, which is the formula the entire world uses to price options. It's fundamental.
We're talking about Nobel Prize winners here.
And they won the Nobel Prize in economics in 1997, specifically for their work on derivatives and asset pricing, while they were partners at LTCM. It wasn't past glory, it was current glory.
So you have the best trader on the street, Meriwether, and the academics who invented the math of modern finance, Merton and Scholes. It's like having Einstein and Henry Ford starting a car company together.
That's a great analogy. It gave them an aura of complete invincibility. They were viewed as the central bank of volatility. When they walked into a bank to ask for a loan, the bankers didn't ask tough questions. They were intimidated. They just asked, how much do you need?
And for the first few years, that arrogance seemed totally justified. Let's look at the golden years from 1994 to 1997, because they were just printing money.
The returns were absurd, net of fees. And remember, their fees were higher than anyone else's, 2 and 25. They returned 20% in 1994, then 43% in 1995, and 41% in 1996.
43 and 41% back to back in a strategy that is supposed to be low risk arbitrage. That's nearly impossible.
It was the envy of Wall Street. Every major bank wanted a piece of the action. They were tripping over themselves to lend to LTCM just to get a glimpse of what they were doing, to see the trade tickets.
But this incredible success, it planted the seeds of the collapse. We hit the turning point at the end of 1997. And this is really where the math starts to turn against them. What happened?
The problem of scale. It's a classic problem. Arbitrage is not infinite. There are only so many mispriced bonds in the world. As LTCM got bigger and bigger, they had more and more money to deploy.
And copycats started showing up.
Exactly. Other banks saw what they were doing and started mimicking their trades. So the opportunities started to dry up. The spreads were getting thinner and thinner.
So you have a choice at that point. You can accept lower returns. You can tell your investors, hey, the party's slowing down. Or you could take more risk.
And they chose risk. But they did it in a specific structural way that is just fascinatingly arrogant. At the end of 1997, LTCM made a fateful decision. They returned $2.75 billion in capital to their investors.
Wait, they gave money back? That seems counterintuitive.
Yeah.
Usually funds want to keep assets under management because they charge fees on them.
They gave the equity back. But, and this is the absolute critical point, They didn't sell the assets. They kept the same massive portfolio of bonds and derivatives. They just replaced the equity they returned with more debt.
So they swapped their own cushion of cash for borrowed money.
Exactly. They drastically increased their leverage. They reduced their equity base while keeping the debt mountain high. And they did this for one reason: to boost their return on equity, their ROE.
Right, because if the denominator, the equity is smaller, the same dollar profit looks like a much higher percentage return.
Precisely. They were trying to manufacture those 40% returns in a market that was now only offering maybe 10% opportunities, and the only way to juice that return is with leverage.
And they did this right as the macro environment was turning against them. We're entering 1998. The Asian financial crisis from 1997 is still rippling through the entire system.
The world was getting nervous. The Asian crisis had really spooked investors. You're seeing a classic flight to quality. Investors were moving money out of anything that seemed remotely risky and piling into the safest of safe havens, like U.S. Treasuries.
Which is the exact opposite of what LTCM needed.
Precisely. LTCM is essentially short volatility and long illiquidity. They need calm, rational markets for their spreads to converge. But the world was becoming volatile and irrational. The stage was set.
Let's get into the practical mechanics. We've talked about the concept, but I want to dig into the actual trades. What was in the book?
Yeah.
Because it wasn't just one thing.
No, they had a few core buckets. A big one was the swap spread trade.
Explain that for us.
So a swap spread is the difference between the interest rate on, say, a corporate bond, or more often an interest rate swap, and the yield on a government treasury bond of the same maturity.
Okay, so corporate stuff is riskier, so it should yield more.
Right. A bank or a corporation might default. The U.S. government, in theory, will not. So the corporate rate is always higher. LTCM looked at the historical data and bet that that spread was too wide. They were betting that the gap would narrow, that corporate yields would fall relative to treasuries.
So they're long the corporate risk and short the safety of the treasury.
Correct. And then there was the volatility trade. This was basically selling options.
Selling insurance.
Exactly. That's the best way to think about it. When you sell an option, you are collecting a premium, a fee in exchange for taking on the risk that the market moves wildly, either up or down. They were betting that market volatility would revert to the mean. They were selling insurance against chaos, betting that things would calm down.
Which is a great trade. I mean, it's a consistent moneymaker until chaos actually arrives.
Then you are on the hook for the payout, and the payout can be infinite.
But I want to spend a moment on the classic bond arbitrage. On the run versus off the run. This is a textbook LTCM trade, and it really highlights the granularity of what they were doing. Walk us through this one.
This one is fascinating because it exploits human psychology as much as it does math. In the treasury market, the most recently issued bond, say the 30-year bond from last week's auction, is called on the run.
So the treasury auction happens today. That specific bond is on the run.
Right. It is the most liquid asset in the world. Everybody wants it. Traders use it to hedge, banks use it for collateral. Because it's so liquid and in such high demand, it trades at a slight premium. It's a little more expensive.
And the older bonds, the ones issued, say, 3 months ago.
Those are off the run. They are technically the exact same credit risk. It's the same U.S. government guaranteeing them. They have the same maturity date, pay the same coupons, but they are slightly less liquid. They're tucked away in insurance company portfolios or pension funds, so they trade a tiny bit cheaper.
So essentially you have two identical items, but one has a shiny new sticker on it, so it costs $101. The other one is in a dusty box in the back, so it costs $100.
That's the perfect analogy, and Meriwether's team looks at that and says, this is irrational. Eventually, the new bond becomes an old bond, the new sticker falls off, that premium must disappear.
So the trade is short the expensive new bond, buy the cheap old bond.
Exactly. You lock in that tiny price difference, you wait for the new bond to age, lose its liquidity premium, and for the prices to converge. In a normal world, it's as close to risk-free profit as you can get.
But, and this is a huge bet, the profit per trade is tiny. We're talking basis points. Tiny fractions of a percent.
It's picking up nickels in front of a steamroller.
So how do you make 40% returns picking up nickels?
That brings us to the leverage engine. You apply massive, massive leverage. If you make, say, 0.5% on a trade, but you borrow enough money to do it 50 times over, you make 25%.
Let's talk about that leverage, because the numbers are genuinely hard to wrap your head around. What was their leverage ratio?
At the start of 1998, their on-balance sheet leverage was about 25 to 1. That's already high. For context, a typical mutual fund is 1-to-1. A conservative hedge fund might be 2-to-1 or 3-to-1. 25-to-1 is aggressive.
But as they started losing equity later in the year, that ratio went higher and higher.
It spiraled. It hit 50-to-1. Then by the end, it was over 100-to-1.
100-to-1. Let's just do the math on that for a second. If you have $1 of your own money and you're controlling $100 of assets, and the market moves just 1% against you,
you're wiped out. 100%. Gone. A 1% move consumes your entire equity base.
And that's just the balance sheet. That's the visible part of the iceberg.
Yeah.
The real danger was the hidden iceberg, the off-balance sheet leverage.
The derivatives. They had over $1 trillion in notional value of derivatives on their books.
$1 trillion for a fund with, what, $4 billion in equity?
It's almost a meaningless number. And over 60,000 individual trades on the books. A web of complexity that was almost impossible to untangle.
How were they even able to do this? How does a bank look at a fund with 25-to-1 leverage and say, sure, here's another $1 billion, no questions asked?
This is where the reputation of the dream team blinded everyone. Normally, if you or I want to borrow money to buy a bond, the bank demands a haircut.
A haircut. Define that for us.
It's a margin requirement. It's a down payment. If I want to buy $100 worth of bonds, the bank might say, okay, we will lend you $98, but you have to put up $2 of your own cash. That $2 is the haircut. It protects the bank if the bond drops in value.
So what was LTCM's haircut?
Zero.
Zero?
Practically zero. In many, many cases, they were financing 100% of their positions with borrowed money. They would buy a bond, give it to a bank as collateral, get cash back, use that cash to buy another bond, give that to another bank. They were recycling the same collateral over and over again through the repo market.
So they were trading purely with other people's money?
Effectively, yes. And because they used different banks for different legs of their trades, no single bank saw the whole picture. Bear Stearns saw one piece, Merrill saw another, Goldman saw a third piece. None of them realized that LTCM was doing the same thing with everyone else all at the same time.
This brings us to a concept from one of our sources, a paper by Wei Jiang about the wealth effect and amplification. This explains the mechanics of the death spiral. I want to spend a minute here because this is the technical heart of why the market broke.
This is a critical piece of theory. Usually we think of arbitrageurs, people like LTCM, as stabilizing forces in the market.
Right. They are the buyers of last resort. When prices fall irrationally, they're the ones who step in and buy, which supports the price. They provide liquidity. They cushion the fall.
That's how it works in a normal market with a well-capitalized arbitrager. But the Wei Jiang paper explains what's called a destabilizing shift. It asks the question, what happens when the arbitrager themselves runs out of money?
Okay, so when a convergence trader suffers a capital loss, a negative shock from the market, their capacity to bear risk drops.
Their wealth decreases. And because they are leveraged to the hilt, a small drop in asset prices leads to a huge drop in their equity.
So they can't afford to hold the position anymore, let alone buy more.
Exactly. They get a margin call from their lender, or their internal risk management models start flashing red and screaming, stop. So instead of buying the dip, they are forced to sell. They have to liquidate positions to satisfy these risk limits.
And if they are big enough, their selling drives the price down even further.
Which causes more losses, which forces more selling. This is the amplification mechanism. The distressed arbitrager stops behaving like smart money and starts behaving like a noise trader. They amplify the initial shock. They become the crisis.
It's a feedback loop from hell.
And in LTCM's case, they were so huge that they were the market in some of these assets. They couldn't get out. They were short volatility and long illiquidity everywhere. As they lost money, they couldn't double down and wait for the convergence. They had to sell, which pushed the spreads even wider, which caused more losses.
And their models didn't see it coming. They were using value at risk, or VAR. We hear about VAR all the time in risk management. What went wrong with the model?
VAR was supposed to predict the maximum they could lose in a single day, based on historical data. It answers the question. To a 99% confidence, how bad can things get on a really bad day?
But it looks backward. It's using the rear view mirror.
It looks at the past to predict the future, and the fundamental flaw was that the models assumed historical correlations would hold. In normal markets, bonds and stocks might move independently, Or German bonds and Italian bonds might trade with a certain predictable correlation.
But in a panic.
In a panic, all correlations go to 1.
It's a terrifying phrase. All correlations go to 1.
It means everything moves together. Everything falls together. Diversification vanishes completely. And the other blind spot, the truly fatal one, was that the models did not account for their own size.
Endogenous risk. The idea that you yourself are the risk.
Exactly. The model assumed they could exit a position without moving the price. That works if you were trading 100 shares of Apple. It doesn't work if you are the entire market for Danish mortgage bonds. If you try to sell, you crash the market you're trying to exit.
So the stage is set. We have high leverage, massive and illiquid positions, a market that is getting jittery, and models that are blind to a systemic crisis. Then comes the catalyst. August 17th, 1998.
Russia defaults.
Now, clarify something for me. LTCM didn't actually own that much Russian debt, did they? I mean, they had some, but it wasn't enough to bankrupt them directly.
No, that's a common misconception. It wasn't the direct loss on Russian bonds that killed them. They had exposure, sure, but it was manageable on its own. It was the reaction, it was the contagion.
So what actually happened in Russia?
Russia devalued the ruble and defaulted on its domestic debt, these bonds called GKOs. This was a complete shock to the system. Sovereign governments aren't supposed to default on their own domestic currency debt. I mean, they can just print more money to pay it.
But Russia just said, nope, we're not paying.
And this shattered the market's confidence. Investors everywhere realized that the impossible was, in fact, possible. And when investors get that scared, they don't look at spreadsheets, they just run.
And we get that massive flight to quality.
The biggest one in a generation. Everyone dumped anything that looked even remotely risky. Corporate bonds, mortgage bonds, emerging market debt sold. And everyone piled into the safest asset on earth, U.S. Treasuries.
Which is the precise, exact, perfect opposite of the LTCM trade.
It was a direct hit. Remember their core trade? Long the risky stuff, short the Treasuries. They needed that spread to close. Instead, it exploded outward. The gap became the Grand Canyon overnight.
Investors were buying the exact thing LTCM was shorting, driving the price up and causing huge losses for them. And they were selling the exact thing LTCM was holding, driving the price down.
It was a perfect storm. They were hit from both sides on almost every single one of their 60,000 trades.
Let's talk about the single-day loss, because the speed of this unraveling is just hard to fathom.
August 21st, 1998. It was a Friday. In one single trading day, LTCM lost $553 million.
$500 million in a day. That's more than the GDP of some small nations.
It wiped out a huge chunk of their remaining capital instantly, and the bleeding didn't stop. Through September, their capital base just evaporated. It dropped from over $4 billion at the start of the year to under $600 million in a matter of weeks.
They were losing tens of millions of dollars an hour.
And Meriwether is frantic. He's flying to Europe on the Concorde. He's calling Warren Buffett. He's calling George Soros, trying to find anyone to inject capital to stop the bleeding.
On September 2nd, they sent that famous letter to investors disclosing these massive losses. And this triggered what we call the copycat effect, or maybe the vulture effect is more accurate.
This is the predatory nature of Wall Street. Other trading desks at Goldman, at Merrill, everywhere, they knew broadly what trades LTCM was in. It wasn't a total secret.
And when they saw that letter, they knew LTCM was bleeding out. They were wounded.
And when they smelled blood in the water, they didn't help. They started front-running the liquidation.
Explain that mechanism. It's brutal.
It is. If I know you own $1 billion of Danish mortgage bonds and you are about to be forced to sell them tomorrow to meet a margin call, I'm going to sell my Danish bonds today. I'm going to drive the price down before you sell so that you get an even worse price. And maybe, just maybe, I'll be the one to buy them back from you when you are forced to dump them at the bottom.
It drove prices even further against LTCM. It was a run on the bank, but the bank was a hedge fund.
And by late September, Bear Stearns, their primary clearing broker, basically said, we're done.
Why does the clearing broker matter so much in this?
Bear Stearns was the plumbing. They processed the trades. If LTCM ran out of cash to pay margin on a losing trade, Bear Stearns would be on the hook for the loss. So Bear Stearns looked at the accounts and said, you have $500 million left. You need $500 million just to cover today's margin calls. If you go below that, we are seizing your assets and liquidating you.
They faced massive counterparty risk. And this is the moment where it stops being an LTCM problem and starts being a global economy problem.
Exactly. If LTCM defaulted, they had trillions in derivative contracts with every single major bank on Wall Street. If they couldn't pay, those banks, Goldman, JP Morgan, Deutsche Bank, would take massive multi-billion-dollar losses on their own books all at once.
It wasn't just about LTCM anymore. It was about the solvency of the entire banking system.
The plumbing of the financial world was about to clog up and explode.
This is systemic risk realized.
Yeah.
So the question arises, and it's a fair one, why not let them fail? This is capitalism. If you make bad bets, you lose. That's the rule.
And that was the initial sentiment from a lot of people. Let them burn. But the Federal Reserve, specifically the New York Fed, looked at the fire sale risk.
What does a fire sale look like at that scale?
Chaos. If LTCM defaulted, the banks would immediately seize their assets, all those bonds, and try to sell them on the open market to get their cash back. You would have over $100 billion of complex, illiquid bonds hitting a market that was already completely frozen.
Prices would go to zero. There would be no bids.
Or close to it. It would have crashed the corporate credit market. It would have crashed mortgage markets. It would stop companies from getting loans to operate. General Electric, Ford, IBM, they wouldn't be able to issue commercial paper to pay their workers. The indirect economic damage was completely incalculable.
So the Federal Reserve steps in. But importantly, and this is a distinction that gets lost in modern politics, especially after 2008. This was not a bailout in the traditional sense.
Right. And the Fed chairman at the time, Alan Greenspan, was very clear about this in his testimony. No taxpayer money was used. The Fed did not write a check.
It was a private sector facilitated recapitalization.
Which is the fanciest possible talk for the Fed locked the bankers in a room and made them pay for it themselves.
Set the scene for us. September 22nd. The Federal Reserve Bank of New York.
William McDonough, the head of the NY Fed, calls an emergency meeting. He brings in the heads of the biggest banks on Wall Street. The CEOs of Goldman Sachs, Merrill Lynch, JP Morgan, Morgan Stanley, UBS, Deutsche Bank, everyone.
The Avengers of Wall Street. Yeah. Or maybe the Legion of Doom, depending on your perspective.
They gather in this big, imposing boardroom. The Fed acted as the chaperone, the mediator. They basically laid out the books and said, look at the disaster. If this thing goes down, you all go down with it. You are the counterparties. You are holding the bag. Fix it.
It's a hostage negotiation, but the banks are holding themselves hostage.
There was a lot of anger in that room. The banks hated LTCM at that point. They felt deceived by the level of leverage, but they ran the numbers. They realized that writing a check to save LTCM was cheaper than the catastrophic losses they would all take if LTCM failed.
What was the deal they came up with?
A consortium of 14 banks agreed to inject $3.625 billion of their own capital into LTCM to keep it afloat.
In exchange for what? What did they get?
In exchange, they took 90% equity ownership of the fund. They effectively bought the fund for the price of saving it.
So the original partners, Meriwether, Merton, Scholes, they were wiped out.
Almost entirely. They were left with 10%. But that 10% wasn't a reward. It was an incentive. It was to make sure they would stick around and help unwind the mess. The banks needed the dream team to manage the portfolio because nobody else on earth understood all 60,000 trades.
You made this mess, now you're going to clean it up.
Exactly. But their personal fortunes that were tied up in the fund, gone.
There was a moment of high drama with Warren Buffett right before the deal closed, wasn't there? A different path that almost happened.
There was. Buffett, along with Goldman Sachs and AIG, made a bid. He offered to buy the entire portfolio for a paltry $250 million. He would have injected capital, but he would have wiped out the partners completely zero equity, fired immediately.
Why didn't they take it? That seems cleaner, in a way.
It was a timing issue and a structure issue. Buffett faxed the offer, literally faxed it, and gave them something like an hour to accept. But legally, Meriwether couldn't sell the fund without a vote from all the partners who were scattered around the world, and the structure Buffett proposed was legally complex. The time just ran out.
So the bank consortium deal was the only option left on the table.
The banks put the money in, took over the fund, and prevented the fire sale. The immediate crisis was averted.
And then what? Did they just close it down the next day?
No, and that was the entire point of the rescue. They performed an orderly liquidation, they held the assets, they waited.
They waited for the panic to subside.
And over the next year or so, markets calmed down. The flight to quality reversed. People started buying risky assets again. And guess what?
The spreads converged.
The spreads converged. The trades worked. The banks eventually got their $3.6 billion back with a small profit on top.
That's the ultimate crushing irony of this entire story, isn't it? The trades eventually worked. The math was right.
The math was right. The timing was disastrously wrong. And leverage kills you on the timing.
Let's pivot to the investor context. We aren't managing billion-dollar hedge funds, but there are so many lessons here for anyone managing any kind of portfolio.
Absolutely. The first and biggest lesson is the illusion of diversification.
LTCM thought they were diversified. They traded bonds in Russia, equities in Japan, mortgages in the US, currencies in Europe. It looked like a global map of assets.
But they really only had one trade on. They were short volatility everywhere. They were betting on stability and rationality. When global volatility spiked, the correlation of all those seemingly different assets went to one. They all moved together against them.
So you have to ask yourself, are my diversified assets actually dependent on the same underlying factor, like liquidity or low interest rates? If the market crashes, does everything I own go down at once?
The second lesson, liquidity is not a constant.
This is such a big one. We all assume we can always sell a stock or a bond.
We model liquidity based on historical averages. We assume we can always get out at the last traded price. But liquidity is a coward. It disappears exactly when you need it most.
When the building is on fire, the exit door shrinks to the size of a keyhole.
Exactly. You should never model your risk based solely on benign historical periods. You have to stress test for the scenario where there are no buyers at any reasonable price.
And counterparty risk management. This is one for the bankers and institutions listening.
The banks completely failed to stress test their exposure to a single entity. They looked at their own leverage, but they didn't really understand or aggregate their exposure to their counterparty's leverage. They didn't see that LTCM was leveraged 100 to 1.
It's the interconnectedness. You aren't just betting on your own solvency. You're betting on the solvency of the guy sitting across the table from you.
You have to know who is on the other side of your trade, and you have to understand their risks.
Finally, moral hazard. This event set a precedent that we are still living with today.
It absolutely did. It taught Wall Street a very powerful lesson. If you are big enough and interconnected enough, the system will save you to save itself.
The birth of modern, too big to fail.
That concept expanded beyond just commercial banks to include massive hedge funds and other non-bank financial entities. Many people argue this mindset paved the road directly to the 2008 financial crisis. Risk-taking increased because the ultimate downside total annihilation was seemingly taken off the table by the Fed.
Which brings us to the one question. The question that sums up the entire LTCM saga and maybe all of investing.
The question you must always ask yourself: can you remain solvent longer than the market can remain irrational?
That's the famous Keynes quote.
It's the epitaph on the tombstone of LTCM.
Why does that matter so much? Why is that the final word?
Because being right and being dead look exactly the same on a balance sheet. LTCM was mathematically right. The spreads eventually did converge. Their core theory was sound. But they were leveraged so highly that they couldn't survive the irrational interim. They ran out of capital. They ran out of time.
So let's just recap what we've covered today. Leverage turns small probabilities into eventual certainties of ruin. Models are just backward-looking maps of a territory that can completely change its terrain during a crisis.
And the smartest guys in the room are often the most dangerous, precisely because they believe their own math over the reality of the market. Markets are human, math is not, and when the two collide, human fear usually wins in the short term.
That's it for this deep dive into the collapse of long-term capital management, a story of genius, hubris, and the absolute limits of human foresight. No advice, just facts. Thanks for listening to Talk Tickers.